Hi everyone, welcome to Bond Bytes, the daily bond market highlights from INRBonds. I'm Arjun Patsarthi, and in today's market, government bond yields rise in anticipation of Fed rate hikes and in anticipation of RBI maybe guiding for rate hikes in its October policy review, which is scheduled on the 6th to 8th of October. The Sensex in rupees are stay steady, and US Treasury yields rise again as markets brace for Fed, the US Federal Reserve tapering of bond purchases and maybe hiking rates sooner than expected. In the corporate bond market, SBI perpetual bonds, a new bond which had a 5-year call option, which was issued at a rate of 7.72% coupon, is trading has seen a sharp fall in yields. It's trading at 7.48% in the secondary market, and good volumes are happening both on the institutional and the retail space. Obviously, INR bonds has covered SBI perpetual bonds, its positives and negatives in its previous bond bites. And you can always go to our playlist to check all the previous bond bites that we have put out. With the festive season approaching, which is October you have October to November, you have the festival season in India, and then December you have Christmas. So the period October to uh, December is normally a very strong period for the economy, both India and abroad. In India, you have a lot of demand given a lot of festivals coming up, and many of the producers cater to this demand, and you could see very strong sales. But having said that, there is still a bit of supply shortage in many places. There is logistical issues in transportation of goods and services. Then suddenly you have got shortages of coal, which then prices are moving up, and also globally you have oil prices moving up, and in the global markets too, holiday season is expected to see strong sales, and there too there is still a lot of supply shocks given COVID is still prevalent in many parts of the world. So with all this, the next quarter could see a very sharp rise in inflation expectations, both in India and in the global markets. And if this continues, then with the Fed also signaling that it's going to end its bond purchases, and if inflation rises much faster than expected, then they could even start to raise rates sooner than later. And the RBI will also have to be very, very watchful of this, because we saw in the 2013 period when the Fed started to talk about taper, we had a huge reaction in Indian bond market. Bond yield spiked very sharply. The rupee also fell to all-time lows, and RBI had to take drastic steps. So this could signal that RBI may be watchful and could also try to prevent such such very sharp market volatility by being preemptive on rate hikes. So how do you position for rate hikes? Clearly, fixed income investors have a problem because rates are very, very low now, and potentially they could rise. So if they continue to stay in investments where they are in fixed deposits, then they could see still very low returns, and inflation is very high. So they are earning negative returns. While if they invest in other fixed income products, then with interest rates going up, bond yields could also rise, and they could see fallen values of the bonds, which will impact portfolios of mutual funds and other other fixed income products. So the best way to position is to see the bonds that are available in the market on the yield curve, and select the bonds that could which with offering reasonable returns with a short maturity period, so that when the bonds mature, then the reinvestment can be done at higher levels. And at the same time, investors get a higher rate of return than what they're getting now without much problem of risk. Only risk here is that if they need that liquidity and they go to sell the bonds, then they might face some capital loss, but that could be covered by the coupon that is coming off on the bonds. So this is one way to position for rising interest rates. And with this, don't forget to enroll for a bond advisors certification program, essential for bond advisors, especially with so much of events happening in the market and with bond deals at ultra lows. Then advisors, financial advisors have a huge problem in advising their clients on where to invest in fixed income. So INR bonds gives you the tools to analyze markets. Also, we provide the real-time analysis as well. And financial advisors find our programs extremely useful, given that it's not only fundamental, but it's also it's real time with INR bonds providing cutting edge analysis on bond markets so that advisors can advise their clients much more effectively. And also they can access our quick invest platform to see the best bonds, curated bonds on offer, where investors can invest in the least risk at the best price and the right bond for their portfolio. Thank you for listening in, and don't forget to subscribe to our YouTube channel if you have not done so already, and sign up for Quick Invest for the best bonds on offer. Thank you very much.